client has been asking me how has the market been doing this week. My answer is confused. Over here, we have two videos that's offering very different views on the war. On the top, we have President Trump saying that the war is going to end very soon. Then on the bottom, we have the foreign policy advisors to the Office of Supreme Leader in Iran, Kamal Karazi. He's giving a very different views on this war. Let's see what he says.
We're ahead of our initial timeline by a lot. I would say that we probably would not have thought after a month we'd be here. In addition to the fact that we've taken out the leadership twice and maybe three times.
You called it an excursion. You said it would be over soon. Are you thinking this week it will be over?
No,
Are you talking
but soon.
about days?
I think soon.
Okay, and with respect
Very
to...
soon. Look, everything they have is gone, including their leadership. In fact, there are two levels of leadership, and even actually, as it turns out, more than that. But two levels of leadership are gone.
It's drastically degraded the Iranian military, the capabilities as far as missiles is concerned, drones is concerned. How much longer can you do this?
The false narratives that the United States government is producing. Iranian military is quite strong, as you see, because they have the motivation, they have the arms that they need, which are produced in Iran. As a matter of fact, we are not dependent on any other country for weapons and arms.
Seeking, or will you seek, a ceasefire with the United States at this point in time, and with Israel?
I don't see any room for diplomacy anymore, because Donald Trump has been deceiving others and not keeping with his promises. And we experienced it in 2 times of negotiations, that while we were engaged in negotiation, they struck us.
So here we can see there's two very different views on the war. We don't know. Let's see how things plays out eventually. Next, we will have a short clip from Tom Lee, who actually predicted the last week's market movement pretty well. It indeed had the lowest dip last week and went back up early this week. Okay, so let's see what Tom Lee has for us this week.
What about oil, right? We're watching it so closely. We're driven by headlines, some of which are apparently erroneous. I don't know what do you do with that?
Yeah, I mean, it's a very confusing time. I think it's very difficult if someone's trying to trade both the headlines or trade oil. But if I look back at the last 2 days, oil's $15 higher than it was last week, but the S&P's higher. So to me, the market actually is handling higher oil prices better. And, you know, we wrote in our note this morning that we think higher oil prices are actually good for the U.S. stock market.
Yeah, see, I think that's going to be a really hard sell for people who are watching this program, like trying almost too hard to paint some bullish scenario. How in the world are higher oil prices, which then mean even higher gas prices, which mean higher jet fuel prices, and all sorts of other issues that are related to that, input costs on a whole number of other industries, how is that possibly good for the stock market?
Yeah, part of it's a relative. You know, one, U.S. is an exporter of oil, so we net benefit as an economy from higher oil. The second is other countries are importers, so the U.S. not only looks better, but on a relative growth basis, it should outperform, which means flows back into the U.S. And the third is, as we worry about global growth for all the reasons you describe, when growth is scarce, people buy growth stocks. The U.S. stock market is a growth index, so it's coming out of the rest of the world back into the U.S. So I think it's a rotation story.
All right.
Many people are looking at this as just another war headline, but I don't think that's enough. This is now an oil story, an inflation story, and for investors, a market story. In today's video, I'm going to do 3 things. First, we will explain how we got here. Second, we will talk about why Gulf of Hormuz matters so much to oil prices and the global economy. And third, most importantly, we're going to talk about investors, especially new beginners who have just started with a dollar cost average strategy and what they should be doing now.
States like these constitute an axis of evil.
If Iran cheats, we can catch them, and we will.
They're a nation of terror, and we won't put up with it.
Before this became a war story, it was already a diplomacy story. In early February, US-Iran talk has already come to a strain. Reuters reported that Washington's condition for resuming the talk included zero uranium enrichment inside Iran, limits on Iran's ballistic missile program, and an end to support for regional proxies. Iran rejected all three actions as unacceptable. At the same time, the nuclear issue itself was becoming more explosive. Reuters reported that Iran had enriched uranium up to 60% purity before last year's strike on the nuclear sites, which Western power says has no credible justification for civilian use at this level, even though Iran says it has the right to enrich uranium for civilian use. Then on February 28, the situation broke open. Reuters reported that the US and Israel launched major strikes against Iran, and Iran's supreme leader, Ayatollah Ali Khamenei, was killed in the opening attack. That was the moment this stopped being a tense standoff and became a full-blown regional war. Over the next several days, the military campaign widened. Reuters reported the strikes targeted Iran's command structure, missile sites, and military infrastructure, while retaliation and counter-retaliation spread across the region. Then, the market's focus shifted from bombs to barrels. By the 3rd of March, Iraq had already cut their production by nearly 1.5 million barrels per day because exports were being disrupted. And Reuters reported those cuts could widen further if tankers could not move through the Hormuz. By the 9th of March, Reuters reported that ship traffic into and out of the Gulf was at an almost complete standstill. Hundreds of tankers were idle. Multiple Gulf producers had cut output, and Brent had surged to around $119 per barrel. So the big picture is this. The war didn't come out of nowhere. It came out of failed diplomacy, escalated dramatically with the killing of Iran's supreme leader, and then became a market crisis once the Strait of Hormuz and global oil flows got pulled into the story. To understand why oil jumped so violently, we need to understand the Gulf of Hormuz. Reuters report that about 20% of global oil and liquefied natural gas moves through this narrow passage. That makes it one of the most important energy choke points in the world. You can think of Hormuz as a pressure valve in the global energy system. When the valve tightens, prices don't wait politely. Traders start pricing in scarcity immediately. As this is where many investors get confused. Oil does not need a complete global shortage to spike. It only needs enough disruption or enough fear of disruption in a critical rod like Hormuz. That is exactly what the market is reacting to right now. Reuters say the near standstill in Gulf shipping, stranded tankers, and output cuts across Iraq, Kuwait, Qatar, and UAE, Britain, and Saudi Arabia are already constraining supply and exports. This matters even more for Asia. Reuters reports Japan imports around 95% of its oil from the Middle East, and governments across Asia are already responding to the shock. South Korea has imposed fuel price caps. Japan is preparing reserves for possible release, and other countries are taking emergency steps to cushion the impact. Now let's connect the dots. War disrupts shipping. Shipping disruption pushes oil higher. Higher oil raises transport and energy costs. Those higher costs feed into inflation. And once inflation becomes a risk again, markets start worrying that central banks may have less room to cut rates. The International Monetary Fund has warned that if oil rises 10% and stays elevated through most of the year, global inflation could rise by about 40 basis points. And that matters because oil behaves like a tax on the global economy. Airline is going to pay more fuel for their fuels. Shipping is going to get more expensive. Manufacturers, they're going to face higher input costs. And consumers can end up paying more for their transportation, their food, and other essentials. And when both companies and households come under pressure at the same time, stocks market will start to worry about slower growth and weaker earnings. Now let's get to the most important part. What should you do if you are new into the investing and you only started dollar cost averaging into global equities recently? First, don't panic sell. If your plan was to invest gradually over the long term, then this kind of volatility is not proof that your plan has failed. It is what it was built for. Dollar cost averaging exists because nobody can reliably predict the perfect entry point for the market, especially during a geopolitical shock. Second, your job is not to predict every missile, every headline, or every oil tick. Your job is to stay disciplined. A lot of investors get hurt not because they pick the wrong assets. It's because they abandon a sensible plan the moment the news gets frightening. In market history, emotional decision making often does more damage than the event itself. Third, don't suddenly turn your beginner portfolio into an oil trade. Yes, energy names may rally in the short term, but chasing what already spiked is usually where discipline goes to die. If you are a beginner, broadly diversification is still a stronger foundation than trying to outguess the next commodity move. Fourth, it's a good time to check your cash buffer. If higher oil feeds into broader inflation, daily expenses can rise. Having enough emergency funds in your banks can give you the emotional and financial stability to continue investing without being forced to sell all at the wrong time. If this video helped you see the bigger picture more clearly, subscribe for more global market updates explained in simple terms for everyday investors, especially here in Singapore.